Getting started with sustainable investing can feel really daunting. A lot of people get focused on all the different possibilities and want to create a perfectly sustainable portfolio. Well, I'm here to say there is a simple and easy way to get started, and I can't wait to show you how it's done. My name is Tim Nash. My company is called Good Investing. I've helped tens of thousands of people invest according to their values. And today I'm going to show you the simplest way to start sustainable investing. When it comes to sustainable investing, the language I use is that we can split it up between doing less evil versus doing more good. With doing less evil, we're trying to earn market rates of return while avoiding the worst of the worst companies. This means you're earning the same returns you would otherwise, but feeling much, much better about it. The doing more good stuff is awesome. We talk about green investments and impact investments. There are lots of other videos on my channel where I cover these things, but for today, we're gonna focus on the doing less evil part to get you started with a sustainable portfolio. So before we get into the sustainable stuff, let's talk about the non-sustainable stuff. If we didn't care about sustainability or ethics at all, investing has by and large kind of been solved. There are these things called one-ticket ETFs, or sometimes we call them asset allocation ETFs. Sometimes they're called all-in-one ETFs. But really, I know that people, talk about not putting all their eggs in one basket, but this is like the one basket that you can put all of your eggs into. So this is sort of a series of ETFs offered by iShares, but there are other companies that offer them as well. They have these different ticker symbols. XEQT, EQT stands for equity. So this is 100% equity. So remember, equity is stocks, fixed income is bonds. So we're baking a pie here. The bonds are that nice crust of the pie, more safe and stable. But the reason we're investing, the reason we eat pie is we want that filling, we want those stocks. So when it comes to XEQT, this has no crust. This is 100% filling. XGRO, GRO, suggests growth, which is going to be 80% stocks, 20% bonds. So a bit of a thinner crust there. XBAL, BAL stands for balanced, which is going to be 60% stocks, 40% bonds. XCNS, so CNS stands for conservative, which is 60% bonds, 40% stocks. And then they even now have this new one, which is XINC, which is income, which is 80% bonds, 20% stocks. So that one's like mostly crust. Really, as someone's younger, they should have more risk. They should have sort of a thinner crust, fewer bonds, more stocks. And then as we get older, or if our risk tolerance is lower, then we're going to want to have a thicker crust. We're going to want to have more bonds inside of our portfolio. So for illustrative purposes, I'm going to look at 100% stocks. So we're going to look at something called XEQT, that this is really just looking at global stocks. Okay, so this is one ETF, but when we look at what's inside of it, it's actually an ETF of ETFs. So there are a whole bunch of different ETFs inside of it. So we can look at it that it's got the iShares S&P TSX Capped Composite Index. This is the entire Canadian stock market, right? It's got the iShares Core S&P Total US Stock Market ETF. This is the entire US stock market. It's got the iShares MSCI EAFE IMI index. EAFE stands for Europe, Australia, and the Far East, which is quote unquote developed countries. And it's even got the iShares MSCI Emerging Market Index ETF, which is emerging markets, countries like China, Brazil, Chile, Mexico, those quote unquote emerging markets. So again, we're buying one ETF here, XEQT, but inside of that ETF, there are all of these other ETFs. And if we didn't care about sustainability, this would be great. This would allow us to buy the entire global stock market all in one go. But when we start to dig a little bit deeper, those of us who care about sustainability are going to see that it is chock full of nasty things. Now, when I open it up, there are 8,776 different holdings inside of this. So again, this is we're buying one fund, but this is a basket of like over 8,000 different stocks. So this is why, this is the one, we don't want to put all of our eggs in one basket unless it's this one basket, right? Or this type of basket that is so diversified that it's good to go. The companies at the top of the list are going to be the largest companies. So the way it works is that every company inside of here has what's called a weighting. A weighting is a percentage. We add up all the weightings of all the companies, we get to 100%. And it's going to be more heavily weighted to the companies that are bigger. The technical term we use for this is their market cap or market capitalization. This is if I wanted to buy every single share of the company, how much is it worth? The largest company in the world right now is NVIDIA. So NVIDIA is at the top of the list. Okay. But as we look at the companies that are in here, we're going to start to see some companies that I'm sure are going to make you cringe from an ethical lens. Again, this is the non-sustainable version. So this is literally every single company, which means that it's going to have things like Philip Morris in here. It's going to have tobacco. It's going to have things like Lockheed Martin. It's going to have weapons in here, right? It's going to have all kinds of fossil fuels in here, like ExxonMobil, so pipelines and coal companies and all that stuff. And it's even got companies in here that are for-profit prisons, companies like Core Civic is owned for-profit prisons, and Geo Group is another one that is for-profit prisons. So if you're worried about all of the ICE situation in the US right now, certainly we don't want to be supporting these companies, but because we're buying this one ETF that has literally every single company inside of it, those for-profit prisons are going to be inside. So if we didn't care about sustainability, this would be the type of thing that we own. But since we do care about sustainability and we want to get rid of those evil companies, we're really, really lucky in that there is the iShares ESG ETF portfolios. So it's kind of going to follow the same pattern. We can see the first letter is now different. Instead of the letter X in the ticker symbol, it's got the letters G. So GEQT is going to be 100% stocks. GRO is growth, which is 80% stocks, 20% bonds. GBAL is going to be balanced, which is 60% stocks, 40% bonds. And GCNS, which is conservative, which is flipped the other way, 60% bonds and only 40% stocks. So these basically act the same way, that these are one ticket ETFs or asset allocation ETFs, right? Or all in one ETFs, because again, this is like the frozen pre-made pie. These comes with stocks and bonds together in one pie. You can buy one ETF across all of your accounts, and this will be diversified enough wearing my financial planner hat. But then what's cool about them is that when we do look at them from a sustainability perspective, so again, I'm going to look at just the stocks part of it. So with GEQT, this is the iShares ESG Equity ETF portfolio. When we look at what's inside, again, this is an ETF of ETFs. So that's why it's okay to put all of our eggs in this one basket, because when we peel back the layers of the onion, we can see that, this really is diversified enough that it's going to have the iShares ESG Advanced MSCI USA Index ETF. So again, these are US stocks, but they use this ESG advanced methodology, which I'll get to in a minute. We have XCSR, which is the iShares ESG Advanced MSCI Canadian Index ETF. And we have XDSR, which is the iShares ESG Advanced MSCI EAFE, or Europe, Australia, and the Far East. Now, there's no emerging markets inside of this one. So this is the type of thing where, sometimes people do want exposure to those emerging markets. It does get a little bit trickier from a sustainability lens. But for me with this pie, it doesn't have emerging markets in there, but that is okay. Such that when we look at what's inside of it, we look at the holdings that are inside, and that it's going to still have a lot of the same companies, but now all of a sudden we're getting rid of all the nasty stuff. So NVIDIA is still in here at a very high weighting, but you'll notice that there actually is no Apple or Microsoft or Facebook. Right? That these are all tech companies that have had really severe controversy. So I'll get into the methodology in a few minutes. But for now, just know that they're not in here. Now, it does still have the Canadian banks right? So we'll talk about that and how even though they do finance a lot of fossil fuels, they're in here. But what's really nice about this is that it does omit all of the fossil fuel companies. So when I search for ExxonMobil, it's not in here. When I search for Philip Morris tobacco, it's not in here. When I search for Lockheed Martin, it's not in here. And even those for-profit prisons like Core Civic, not in here. Or Geo Group, not in here, because all of those things are omitted. So this is very much sort of a doing less evil option, which is great for starter investors. If we want to understand the methodology of like the nitty gritty of what's in and what's out, right, then we can examine the methodology for these ESG advanced ETFs. So the way it starts is that they do use this screening approach. So they are screening out companies. The first screen they use is based on an ESG rating. So ESG stands for environmental social governance. This is code word for a sustainability rating, that they must have a rating of BBB or above to get in here. What this means is that really the highest score when it comes to these ESG ratings is AAA, and then it goes AA, single A, triple B, double B, single B, and then triple C is like the worst. That's like the nastiest, the least sustainable companies are rated triple C. So what they're saying is you must be triple B or above in order to be eligible for inclusion. From there, it does exclude companies with severe controversies, human rights abuses, child labor, product recall due to the death of customers, things like that, where these really egregious situations, right? This is why a lot of those large tech companies are not in here, that most of them in their history have some kind of major controversy that does mean that they're not going to be included inside of this portfolio. It does exclude fossil fuels. So this does exclude all businesses with an industry tie to fossil fuels. Now, there is an exception for companies with more than half of their revenue from renewable energy. So you'll get some renewable energy utilities that are mostly renewable, but have a little bit of fossil fuels in there. They will still sneak through. They also don't look at financing. Fossil fuel financing is not included as part of this. So that's why the Canadian banks, companies like RBC and TD, they've got good ESG scores. They haven't had major controversies. And even though they are the biggest financiers of fossil fuels, right, that's not counted in this definition, which is why the large Canadian banks are still part of this portfolio. From there, it excludes companies with material business involvement in adult entertainment, alcohol, civilian firearms, controversial weapons, conventional weapons, for-profit prisons, gambling, GMOs, nuclear power, nuclear weapons, palm oil, predatory lending, and tobacco. Whew. It also includes cannabis. So if you want your weed stocks, you're going to have to buy those separately. But really what this does is it means that we do have what we end up with are companies that are quote unquote doing less evil. Now, when I talk about this, people are always like, well, Tim, what about returns? Well, this is where I'm really happy to report that the returns are nearly identical. That I use a website called morningstar.com to be able to look these things up, and I can show XEQT, right? And we can look at the performance over the last little while, right? What we saw was very, very good returns. And what I can do is I can chart these returns over the last 5 years against GEQT, which is the sustainable version. And what we end up with is nearly identical performance. And in fact, if we look at it over the last 5 years, the sustainable version has actually outperformed by a little bit. Now, some years it's going to be a little bit higher. Some years it's going to be a little bit lower. It's going to depend based on a number of factors. But the idea is that over the long term, if we're looking at this over decades, we can assume the same expected returns over the long term from the sustainable version versus the non-sustainable version. So you can really see why I love these all-in-one ETFs. They make life so much easier for people that you can buy this one bucket for your entire portfolio. It's as diversified as you need it to be. But now we have these doing less evil all-in-one ETFs, which do the same thing. It's the same level of simplicity and diversification, but in a way that is aligned with our values. If you're ready to start your sustainable investment journey, but need a little bit of help, join my Good Investing Classroom. I've got lots of amazing resources in there, including my new mini course, How to Start Sustainable Investing in 15 Minutes, where I teach you step by step how to actually buy these all-in-one ETFs. I also do AMAs, Ask Me Anythings, twice a month to be able to answer all of your questions. Since you've made it to the end of this episode, I'm so grateful. Thank you so much. If you can do me a huge favor and click like and subscribe and leave me a comment, ask me a question in the comments. I'd love to hear from you. We'll see you next time.